Welcome, everybody, to What's in Store, the show where we cover hot topics at the cross-section of retail and real estate. I'm Karly Iacono, and I'm joined by my co-host, Chris Ressa. Chris, how are you today?
I'm doing great. How are you?
Can't complain. Fired up today. I'm in full Vegas preparation mode. Market's nuts and feeling good. How about you?
Same. Full Vegas preparation mode. Busy show ahead.
Yep.
Getting in Friday night. Start business stuff on Saturday. So excited.
It's going to be a big show. I heard attendance is up. I'm coming in early Saturday morning, and I think everything's moving earlier, right? More focus on parties and events over the weekends.
Way more parties,
Yep.
invites than the past few years. People are back into the entertaining concept in Las Vegas. The amount of parties on Sunday night is through the roof.
Yeah.
So I think it's a good sign. So increased attendance up. Who are the new people coming, do you think?
I don't know who's new. I think maybe it's just people who've realized they missed out the last few years because they decided during COVID they didn't need to go. And now they realized, wait, everybody who's in retail real estate is going.
Okay.
20 to 25,000, my friend.
Yeah,
I mean, that's a big range, but somewhere in there.
It's going to be a lot of people.
It's going to be huge. So, yeah, we'll be there in full force. Like the Super Bowl of retail real estate.
The Super Bowl of retail real estate, yes.
Absolutely. So today, for all of our listeners, we are going to have a conversation about what Chris and I are going to be talking about at our ICSC meetings that we didn't think we were going to be talking about in 2024. So what are the topics that are going to be forefront of our meetings that maybe we thought we'd be done with at this point? So we're each going to share 3 back and forth. And what's interesting is our worlds are very different right now. I think yours is, what did you call it yesterday? Lollipops and rainbows? Sunshine and rainbows?
I use the word lollipops and rainbows a lot. People in the office know that's the phrase I use when things are like feeling pretty good.
Yep.
I wouldn't call it lollipops and rainbows. Lollipops and rainbows compared to some of the stuff we were talking about as it related to your world. But I wouldn't call it lollipops and rainbows. I would say the pendulum has shifted into the landlord favor pretty dramatically.
I'm aware. Thank you. I'm wearing black to symbolize how I feel about capital markets currently. No, I'm kidding. It's definitely a tale of 2 markets. So happy things are good for you. Let's jump in. Kick us off with one theme that you are going to be talking about in your meetings that you just were not expecting.
I didn't expect we'd be having so many conversations about delivering to tenants in 2026 and 2027. When you're doing new development out of the ground, that makes a lot of sense a couple years out. But most of the stuff everybody's talking about at ICSC is existing real estate. There's less new development. And to be talking that far out is really, really interesting to me.
And is this ground up development or these are backfilling spaces?
Existing backfilling spaces, existing stuff.
Wow.
Yeah.
Now, why does it take that long? Because you don't have the space available for the tenants and they're sort of just indicating demand, or is the build out timeline that long?
So 2 different concepts. This one, I'm talking about the fact that there's just no availability of space. The retailers are convicted about their concepts for the long term. They know where they want to be in certain markets. And they're signing up now and building their pipeline down the road because the moment things are available, they're snapped up and they want to make sure that they're getting them. There's a retailer that was at risk from a Chapter 11 perspective. And normally in a Chapter 11 perspective, those spaces either get rejected or go to the bankruptcy court and get auctioned off. We had a deal that if all the bankruptcy stuff didn't happen or did happen, if at some point I get the space back, then I have a signed lease sitting on the shelf with this retailer.
Wow.
So I have no control of the space today.
Right.
I don't know in bankruptcy if I will have control. So those are 2 pieces, right? Right now I'm dealing with an extended lease term. The second piece I'm dealing with is if that tenant filed for bankruptcy and they closed the store and sold the store off and I wouldn't have control. We're talking past those 2 things. If those 2 things didn't come to fruition, I have a deal sitting on a shelf for them to backfill them. So we're talking a couple of years.
backup contingency plans that go a few years out.
Yes.
Wow. Now, what if that same tenant finds another space in the market, right? Obviously, they would pull out of this contingency plan, or are they just putting
They're
out
locked
feelers?
in.
They're locked in.
Yeah.
Wow. A binding contingency plan. That's
Yes.
strong.
Yes.
Interesting.
The way it's structured is I have a long period of time that I have to get possession from the existing tenant.
Okay.
So I can do that in a bunch of ways. A natural expiration, which I don't have. They just close the store and I take back possession, or I work on a termination. So we're both just waiting to see what happens.
Wow. Interesting. And do you think that is strictly a product of tenant demand and lack of availability of space?
I think that's one of the pieces. I think so. Yes, on a high level, but why is there the tenant demand is I think the question, which is, the retailers have a ton of conviction about their concepts going forward. We've gotten totally past the e-commerce narrative and the retail apocalypse, and there's a lot of conviction about this, and they know where they want to be. They know where the growth is. They know where they do well. They have so much more information and data about their customer today, and they're executing on that.
Love it. It's like all full steam ahead for retail real estate.
And as landlords, and I think this goes for everyone. Everyone always has been in the game of, can we upgrade a tenancy at a project?
Right.
However, that is good to say. It's very hard to execute that if you have a portfolio and you have other vacancy, right? How do you focus on the already leased stuff when you've got something to fill? Well, now that landlords don't have nearly as much vacancy, there is a serious offensive move happening in the marketplace where landlords are working on, how do I make this better for the next 10 years and really upgrading tenancy. I have a friend who's not in the business that I was on the phone with today who owns a gym.
Okay.
Little local gym. And he called me last night and I didn't answer. I called him back on the way here today. And he was telling me that he was month to month in his space and the landlord just sent him a termination notice and he doesn't know what to do. Can I help him?
So the landlord has another tenant, definitely better rents, probably better credit. And he's like, thanks for playing, but no.
And I was asking him, why are you on a month to month lease?
Right, exactly. That's so risky.
And he was just, and I didn't talk to him in a long time. And he was just, coming out of COVID. I thought I wanted flexibility.
Exactly.
Yeah.
Wow. Fascinating.
Yeah.
So on the flip side, my world is very different, obviously coming from investment sales, capital markets. The thing that we are still talking about, of course, is interest rates. And even beyond interest rates is price stabilization. And we were hoping, of course, all of us, that we would have interest rate cuts, which have been fantastic. I think that the understanding higher for longer is permeating now and maybe being accepted, not willingly, but, by force. So now we have this mindset that, okay, interest rates are going to be higher for longer. What does that mean for pricing? And we have the buyers in the market saying, well, we need positive leverage. So obviously prices need to come down. Cap rates need to come up. There needs to be a spread. Understood. We have sellers saying, we're losing money if we sell, although we have debt coming due and we might need to sell. So we're just going to wait a little bit longer and see when the market, quote, improves. So it's a standoff. It is still a standoff, which is creating just an incredible lack of velocity in the market and a lot of frustration on both sides. So our job is not predicting interest rate cuts. I think that was like everyone's game for the last year. Like, oh, when's the Fed going to cut? How much? What does that do to cap rates? I think we're done with that. I personally am done with that game. And I think it's more of a, here's where pricing is. Maybe rates come down a little bit, God willing. Maybe they don't. But I don't think anyone realistically thinks there's going to be a tremendous shift in interest rates to the downside, right? I don't think we're getting back ever, personally, to 21 pricing. So where does that put us, right? Are we willing to accept deals with less spread over between interest rates and cap rates, which is the current mindset, right? Buyers are buying skinnier deals. Are sellers willing to come off pricing, or are lenders going to continue to work with them on extending loan terms when their debt comes due? So It's really still a standoff, which I think is amazing that it's gone on this long. And our job as intermediaries, as brokers, is to try to find that middle ground, right? And solve problems for sellers who really need to sell, find opportunities for buyers who are dying to put capital out. There's certainly no lack of buyer demand. And finding sort of the cracks in both sides where a deal can be made is today's challenge.
Yeah, on our side, from a business perspective, our CEO, I had asked him in a recent interview, and I was like, from a business perspective, forget about everybody in the personal side. From the business perspective, do you think it's better for us if interest rates come down, stay where they are? And depends on how good you are in the capital markets, your lending relationships,
For
your
sure.
equity relationships, and there's probably significant opportunity coming for the people who are really dynamic in the capital markets and have existing relationships with both the debt and equity side, and we'll see how that shakes out because the the lower the lower interest rates, it just creates this significant rush, pushes prices up, and you're competing with everybody.
Correct.
This is where we're going to see, a couple of things. Who can perform on the actual property level, because the
Hmm.
fundamentals matter so much more now, because you can't win on financial engineering, obviously, because
Right.
of the positive leverage challenge, and you have to win on the ground from an NOI perspective.
Exactly. So competition is down, which is great for savvy owners. And you nailed it. It's who has surety of close.
Yeah.
That's what everyone's looking for right now. And are you a cash buyer? If you're not a cash buyer, what's your cost of capital? And we're having those conversations every day, all day, to make sure that people really can perform at the levels they say, because the cost of equity is really the key piece right now
Yeah.
in the whole game. So here we are. Not a whole lot of clarity, but certainly I think a more honest look at pricing and interest rates, and hopefully some more movement over time.
So when
We'll
when
see.
when the client goes to you next week in ICSC, what do you think when are interest rates going to move? What's your response going to be? Because that's going to be what your
Um,
clients are saying to you.
they're not. Don't depend on it. If they do, think of it as a pleasant surprise. We have the market we have right now, and we need to learn to find opportunity within it, both on the buy sell side. So I think it's foolish to say, okay, let's revisit this in a year because the whole picture will be different. Maybe it will, but if a deal makes sense today on either side, then it's going to be even better in a year should rates come down. So find opportunity, dig, work hard in today's market. I don't think waiting is going to pay off.
Okay.
How about your number two?
So my number two is, I can't believe we're not talking about more space coming back from bankruptcy.
That's a good one. Yeah.
Uh, we had, and to me, I'll take an angle that I haven't heard a lot, which is because, in my opinion, retailers have such a positive long-term outlook.
Mm-hmm.
Retailers are not willing to give back space, and they've got some fortitude right now and really trying to figure out how to optimize their portfolio. And there was a lot of watch list retailers of folks that have hung in and are continuing to improve their portfolios. And I think I would have thought we would have had, and that doesn't mean there hasn't been bankruptcies. We've
Right. Of
seen
course. Of
bankruptcies, right?
course.
And there has been some closures from it, but I thought it was going to be bigger by now,
Mm-hmm.
especially after the big one with Bed Bath & Beyond last year. And that hasn't come. Maybe we'll be in ICSC Vegas and we'll hear some retailer we didn't
Some big
expect,
news.
some big news that happens
Yeah.
sometimes. I'll never forget, we had the Dress Barn one year when like people were coming to the booth. They announced it while we were there.
Oh my goodness. Wow.
So
Interesting timing.
yeah, it was interesting timing.
Yeah.
But I thought we'd be having more conversations because
Mm-hmm.
there are retailers who are tracking struggling retailers' real estate so that they know the opportunity before it actually comes.
Got to be ready to pounce.
And that list is a little less relevant than it probably was 18 months ago. And I thought we'd be talking about those spaces, and I am shocked we are not going to be.
I think Joanne is the perfect example of that,
Yeah, for
right?
sure.
Like we heard the bankruptcy news and everyone was watching it and then now they're done. And I
Yeah,
think they're closing no stores,
yeah,
right? That's amazing that they were
yeah,
able to restructure with no closures. So
yeah.
maybe we'll see more of that.
It's pretty. It's really the tenant market and the retail market is pretty interesting, and I think everyone's wondering how long of a runway do we have until it spurs new development. I
Right.
think that's the loosening up that some
Mm-hmm.
retailers would want. But I mean, today, if you were building like a power center, I think you'd need, I don't know, 30s in net rent from boxes in
Right.
order to
Just
make
cover
it
the costs.
work,
Right.
and so it doesn't work.
Right. Exactly. And although I think construction costs are softening, they're coming down a
Yeah,
little bit, not to the point where those deals pencil yet.
for sure.
So I'm not sure what the catalyst is to make that really shift, but it's a challenge right now for new
I think
construction.
I think what I think what's going to happen is it's clear to me that rents are going to keep rising. It's you read any macroeconomic thing, and if you're in the day to day, rents are and their rents are rising, and to that end, there will be a point where the rents will rise, and then someone will say, "Well, if I can pay this and my sales are strong, can I pay it for a
Build to suit.
new build to suit or something
Right.
like that?"
Exactly.
And we're just not there yet.
Right. Not long. Let's see. We'll revisit this next year. It could be
Yeah.
a totally different dynamic. So my number 2 is a transition to value add investing. It's a complete inversion of demand in the last few years for the type of product that I sell, primarily single tenant net lease. So for the last 10, 15 years, really, the focus and the demand has been on investment grade, shiny new builds, long-term leases, the pinnacle of stability. That's what all of our institutional investors wanted. That's what all the private clients wanted. It was a fight on the brokerage side for who can represent these developers because the product literally flies off the shelf, right? Whole careers were made on the expansion of drugstores, CVS and Walgreens. I mean, there are brokers that have just sold those and made ridiculous amounts of money. Now, the conversation is so different, right? We have those new builds, but they're very difficult to sell because the cap rates are low, usually lower than interest rates. You're looking for cash buyers. Often there's no escalation in the leases. So the conversation has shifted to what do you have that's value add? What opportunities do you have? What I can re-tenant? And that used to be our high risk tolerant buyers. It was a very different profile, and they were kind of like in their own category. Like, okay, we have these value add buyers who maybe go for leases with 2 or 3 years. They're kind of bottom feeders. Not a very nice way to say it, but it's true, right? We're like, right, we know those buyers. Now that is every buyer. Right? They're taking shorter lease terms. They're looking for maybe less credit. And it makes all the sense in the world. It's just a fascinating shift in demand economics. And it's really driven by the need for cash flow and the need for yield. And there's only so many levers you can pull on a stabilized property by design, right? It's meant to be a set it and forget it asset. It's meant to be stable. It's meant to be long term. But if you're not getting significant cash flow, maybe none, the buy, what does that look like in 5 years? Not to say there's no buyer that these work for, but it's harder from an investment perspective. So more of the ICSC meetings I'm expecting will be started with a higher risk tolerance because right now risk seems to equal reward instead of risk. Like it's not separated risk reward. Now it's take on the risk to get the potential reward. And before it was, we don't want risk. We want what everybody else wants.
Are you finding those opportunities to sell?
We are. Actually, we have a best and final today, which is why I was late. We have a ton of offers. It's a higher yield property, shorter term leases. And we have, I think at this point, we've got about 10 offers. We'll see what comes in the next few hours. So
Multi-tenant?
it is multi-tenant.
Okay. Are you seeing a lot of value add net lease deals?
We are. Actually, I have a portfolio of shorter term deals on market, discount stores, and we have 2 moving to contract right off the bat, high yields, 2 that have significant interest. So we are, and I think value added net lease is what I mentioned. It's shorter lease terms, it's below market rents. Maybe you're going down the credit spectrum on tenant, but you like the location. So value add means something different to everybody, right?
Sure.
It could mean just slightly higher risk from a stability perspective. But the mindset is, I know I can re-tenant this because of everything you just spoke about, right? The tenant demand is there. There's really no vacancy in the market. So the risk is not of the tenant leaving as much as it used to be. It's more, can I replace the rent when they leave? And what does this deal look like when I re-tenant it?
So that portfolio of discounters, why is the seller selling that?
That client is a REIT that is divesting retail in general.
Interesting.
So it's their business model. It's nothing related to the specific locations. They're just shifting their overall strategy.
Is it a multiple state or one state?
Multiple state.
Okay. How many?
There are 4, 2 more likely behind it.
Interesting.
Yeah. So that's a shift. And
That
we'll
is a
see
shift.
how all the meetings turn out. We still have the flashy new product. It will move. It's just it's been more challenging.
There's, on some of the flashy new product, there's this backlog, right, of deals. Are people talking about that from the buyer perspective? Is that actually impacting? Someone goes and wants to buy a whatever net lease, I don't know, a Chase Bank, and they're like, wow, and I don't know what the number is. There's 100 other Chase Banks on the market that haven't sold yet. Is that impacting buyers?
It does, because the market dynamics right now are such that buyers have the power, right? Because there are increasing inventory levels. There are less buyers because we have less exchanges happening. We have less private clients coming into the market because they can put their money elsewhere. There's just overall less transaction velocity. So buyers have more choices. And when they have more choices, they're looking a lot more closely at the full inventory portfolio and saying, okay, there's 173 Starbucks on market. It's crazy, right? A few years ago, there were like 12. So that's a perfect example of inventory building. And the buyers will say, we love Starbucks. We love their credit. We like the concept. We like there's a drive-through. There are so many great things about Starbucks. I'm not negative on Starbucks in general, but they're going to look at those 173 locations and say, let me put out 10 offers and see which seller bends the most. Let me be really specific on location. If I see something I don't like before, they probably would have said, it's not ideal, but no deal's perfect. Now they're saying, I don't like that line in the lease. We'll just go find another one. So it's very difficult to keep buyers focused because they have so many choices.
Got it.
Now.
All right.
It's fun. Are you jealous? Do you want to move to the other side of the table yet? No, I'm just kidding. We'll obviously it all works through the system.
Yeah.
All right. Tell me what are we on? 3?
3.
Number 3.
I can't believe we're going to still be talking about delivery timelines. So on a lot of things, we worked out the kinks from a timeline perspective on a construction from, call it, sign lease to tenant opening. But as a market, and it depends on which market you're in, from approvals to getting permits to actually lead times on items, there's still some kinks along the way that are extending delivery times, and it is definitely a challenge. It's not in every scenario. They've improved significantly, but there are some where a lot of things, changed for certain municipalities or utility companies, and they're status quo. We're still longer on HVAC. Everyone's still buying HVAC much earlier in the process than they had to because it's still longer than it was pre-COVID. Will it ever get back? Maybe. But there's things like this that just haven't worked itself out, and we're years later now.
Why do you think that is? Do you think the suppliers have just gotten used to this timeline?
I think the ramp up in these inventories was so significant, and it put so much pressure on those municipalities, vendors, manufacturers, general contractors, architects, everyone in the whole channel, that they're still working through the backlog. They're still working through. And now, while they're working through the backlog and while there's less new construction, there is a lot of deals happening, as we've talked about, in existing stuff. So, like, they just can't catch up.
I worry that becomes the new normal for municipalities.
Yeah.
Right?
Yeah.
It's almost that political small government side, like, we've always done it. And by always, we mean in the last 3 years, 4 years, always done it in 2 years. Like, we
Yeah.
could never do a year. Meanwhile, it probably was a year or 6 months for approvals pre-COVID. So what do you think makes this change?
So I think we're going, in the short term, I don't know. In the long term, I do believe on every piece of this channel, technology is going to move faster than we think here. I think it's going to help. It's going to take a little while, but once it does, it's going to accelerate this.
Interesting.
Yeah.
So technology is the answer to make people more efficient, even in real estate.
I think technology has a real opportunity to make an impact. I also think, can new business ventures start up, right? On the HVAC front, like, the amount of HVAC manufacturers that we use in all forms of commercial real estate is pretty limited.
Yeah.
You would think that there would be a lot. Like, conditioned space is something for residential, for
Right.
commercial, pretty universal
Yeah.
worldwide. And there's very few companies that have this market, like, gobbled up.
Right.
I've been wondering, like, I'm sure it's hard to start up a HVAC
business?
an HVAC, business. And I don't mean like an installer. I mean an actually manufacturer product. But I don't know of any that, like, started up, and we didn't hear about this new one coming to market that's gonna, solve the problem. So new competition always helps in, competition usually speeds up business processes.
Of course.
Right. So in any world in this whole, channel from, deal signing to actually new product opening, whether that's multifamily, industrial, retail, competition helps speed up that timeline. I think technology will, but as it relates to Vegas, we're going to be talking about that for sure.
And do you think it's supply chain or politics? Because I'm not sure how competition or technology will improve the politics of local municipalities.
So I wouldn't say
both?
supply chain.
Okay.
Right? We're not getting caught on barges anymore.
For
right?
sure. There's a little more to it than that, but okay.
Right?
Yeah.
I would say just the availability of the product, right, to actually manufacture it, right? When you build something, you need trusses. Well, trusses are usually custom to that building that you're making. They're longer than they were before, right? So that's not the supply chain, how we're thinking about the logistics portion of the supply chain.
It's not logistics. It's actual manufacturing.
There's manufacturing. There's competition for product.
Right.
And a lack of vendors, in my opinion, for that product. And then I don't know that I wouldn't call it actually politics. I would just say on the municipal front, to get through the process, not necessarily the politics, but the process is challenging.
Interesting. So basic inefficiency of government, but not necessarily politically motivated on approvals or not.
Yeah, that's not it. It's just like their timeline to do things is long, and like if they might cancel a meeting because for whatever reason they cancel a meeting. Well, now you're a month out. You got to go to the next meeting. Like, why did they cancel that? Well, we weren't going to have enough of the board here that week. We got to go. Like, there's Someone had to work late. These
Lack of
people have
efficiency.
jobs, right?
Yeah,
These people have
yeah.
jobs. Someone had to work late. They had to cancel the meeting. Those
Right.
are some of the things that happen.
And meanwhile, we're waiting, right, with bated breath for this meeting for the full
Yeah.
month. And you're like, you can't cancel. And they're
Yeah.
like, yeah, we'll see you next month or not. We'll
Yeah.
see, right?
Exactly.
Just not as important. Very interesting. I'm not sure how to solve that, but I like the technology piece. So
Yeah,
we'll hope that comes into play.
for sure.
So my last one is not new, but it's something that I think I'm surprised we're talking about as though it's this new focus, and that is an enhanced look at real estate fundamentals. And it's funny because real estate is all about location and actual real estate fundamentals. I mean, that is the core of what real estate is, right? But for the longest time, and we're talking like, again, 10 years, 15 years, it's been more heavily slanted to the financial engineering ability of a property, the tenant credit, and the lease structure. Now, all those things still matter, of course. They're very important for financing and so forth. But now we have this increased focus on the dirt again. So it's like when the world turns upside down, everyone goes back to core, which I think is right. I think that's the mindset, right? You have all this instability in the market, so you come back to basics and say, okay, let's build a deal in our mind, not actually build it, but let's build a deal that makes sense from the ground up. What does the dirt look like? What is the access? What's the traffic counts? And again, these aren't new, but everyone is talking about it like, wow, I mean, what's the Placer report for that? Which is new, by the way. We love Placer. What's the data look like? What is the demographic shift? And before it was, the conversations always started with, what's the tenant's credit profile and how do you think that'll be changing in the next 5 years? And now it's, do we think that this location will have increased demand over the next 5 years from a leasing perspective? So it's a shift in evaluation strategy that I think is really interesting.
Okay. Yeah, I think on the multi-tenanted front, haven't lost that, like, let's talk about the fundamentals of what make a great piece of real estate, right? Access, visibility in the multi-tenanted, the co-tenancy, the sales at the project. These are all things that, have been pretty paramount for us. And, we've always had the significant positive leverage as the gravy on top of the actual fundamentals.
And I think that is much more common with multi-tenant investing, and especially at a larger scale, not necessarily the small multi-tenant, but grocery anchored. I think that makes all the sense in the world. For single tenant, it's a shift.
Yeah, that's wild.
Definitely a shift. So we're ready. We're ready to answer all the questions. I've got all the Placer data. We've got all the information. It's just interesting how the conversation is switched.
When over the last 5 years, you were going to a meeting in Vegas where you were talking about a potential site to sell for a buyer, and the conversation wasn't, this is the best corner in the market, has the best, there's a billboard, there's a train stop here, a billboard, this makes it more valuable. We weren't talking about those things.
It was mentioned.
It was mentioned.
But now it's starting with that, right? Before it used to be the credit of the tenant is A-, S&P rated, highest level, right? Ultimate security. The lease term is 15 years, triple net, no management responsibilities, right? Here's what the financing looks like. Here's your delta between the interest rate and cap rate. Here's your cash on cash return. Here's why this is a stable property. And oh, by the way, it also happens to be in Florida or wherever, right? Name your market. And it was like, oh, neat. Okay, great. Wherever it is fine.
How much do you expect that potential buyers will want to know about the other real estate in the market? So one of the things when we're buying, right, if we're buying this, where's the competition and are we outpositioned? Right. And what does that mean? Well, are they talking about that?
Lately, yes.
Wow.
That's one of the new shifts, right? Wow. And especially with things like the Family Dollar closures, which is not dramatic in my mind. It's a small portion of their portfolio, the stores that they're closing. It makes sense for them to prune underperforming locations. But what news like that does for the private client market is shake things up. And they say, wow, these these stores could close, because that's not usually how people start with net lease investing. They believe it will always be long-term, of course. So if they're closing stores, how many are in the market? Which ones are they closing? Do I have a better store, or do I have one that's not as well positioned? And even if they're not buying a Family Dollar, insert whatever tenant, as you see tenants prune underperforming locations, which they always do, that becomes more of a conversation piece. That how am I positioned? Should this tenant want to change their real estate strategy in 5 years, 10 years, this year? And what does that look like?
If you heard some of the due diligence things we're asking in it, you might be like, oh my God, please don't come to net lease, because we're gonna, in some of our centers, right, we're gonna do tenant interviews beforehand. Like once we have a contract, we're gonna, in due diligence, we're gonna do tenant interviews. I'm gonna want to know, how long is that store? The store manager is everything in the store. It's way more.
Okay.
It's more important than the real estate most times.
Interesting.
So I want to know, how long has that person been there? Have you had major turnover in this store from a store management perspective? Store's going to be struggle to take off if every year the manager changes.
Right.
This person's been here 5 years. The team loves them. Okay, that's good stuff.
Okay.
So there's a lot more potentially of these
right.
questions coming down the pike for your world, because if they have anything like how we're thinking about it.
I'm ready.
There you go.
Bring
I
it
like
on.
it.
Not
Awesome.
scared. All right. Well, I, for one, am very excited about Las Vegas.
Me too.
Did I tell you I was speaking this year?
No.
It's been a goal to speak at the flagship, the
Awesome.
mothership of commercial real estate, retail real estate conferences. So yes, excited to put that in the mix this year as well. So
Very cool.
come visit. I will be running from the booth to the stage and running back.
So
the plan.
I've spoken a couple of times. One of the things that is interesting, it's usually one of the bigger audiences you have. So
Correct.
that's good.
Yep. I'm excited. It'll be fun.
Awesome.
Well, can't wait to see you in Vegas.
Yes.
To everyone listening, we hope we will see you there as well. And if you are not at ICSC Las Vegas, connect with Chris or I after the show. We're happy to share our perspectives and tell you what we learned. I think that's a wrap.
That's a wrap.
Thank you so much for tuning in. That was What's in Store with Karly and Chris, and we will see you again very soon. Have a great day, everyone.
Audio Jungle.